Hello, thank you for taking the time to watch this presentation. My name is Zachariah O'Dare. I'm a student in the Finance 498 course, and this is my senior capstone presentation on United Healthcare. Today, I'll be walking through a comprehensive financial ratio analysis of UNH compared against two of its primary competitors in the health insurance and healthcare service spaces in CVS Health and Cigna. The goal of this project is not just to show the ratios to you, but to also help give an understanding of what they mean and what story they tell about UNH's financial strength, its operating model, and its valuation. Throughout the presentation, I'll be using things like 5 years of financial statements, calculated ratios that were done in Excel, and cross-checking the trends against management commentary that we saw in their 10K and 10Q filings most recently as of this year. I'll break down the performance across things like liquidity, solvency, profitability, as well as ROE and valuation multiples, and then we'll tie it all together with risks that are specific to United Healthcare's model. With that, we'll move on to the table of contents. As I mentioned, we'll be giving a brief overview of the company, talk a bit about the project scope, do a liquidity analysis, a solvency and leverage analysis, a profitability and DuPont analysis, some management commentary on the 10K and 10Q, talk about the valuation multiples, look at some specific risks to UNH, and then finally conclude. So, opening up, to understand the ratio results later, we have to first understand UNH's business model. United Health Group is not just the nation's largest private health insurer, it's the largest healthcare company in the US by means of revenue. UNH consistently sits near the top of the Fortune 5, moving between positions with Amazon, Apple, Exxon, depending on the year and how the market is doing. UNH generates its revenue through two completely different business engines, as you can see here on screen. The first being United Healthcare, which is the insurance side of the business. This is the traditional model that most people think of when they hear health insurer. UNH collects premiums and pays medical claims, and the scale that they're working on at this point is very massive. They cover over 500 million members across employer plans, whether that be Medicare Advantage and Medicaid. A bit of where it differentiates itself is in its second segment of Optum, which you see on screen. Optum is a health service ecosystem inside the company of UNH. Optum manages pharmacy benefit services, they run care delivery and clinics, and they also sell data and analytics to hospitals and providers. This service segment generates more stable revenue for UNH and typically carries higher margins than the insurance underwriting that's done in the core business. The key is that some of the competitors that we're going to be looking at today in CVS and Cigna don't have the same business mix necessarily, which of course differentiates UNH. CVS leans heavily on the retail and pharmacy benefits with their brick and mortar stores, and Cigna is still primarily just focusing on insurance. UNH is able to spread its earnings across two structurally different streams, one based on risk underwriting and the other based on Optum, which is again data, pharmacy services, and care delivery. And this definitely shows up later in the ratios, especially in its profitability and return on equity, which we'll be getting to soon here. In terms of not just calculating ratios, we've also want to look at the scope of the project. The scope of the project also included connecting the financial performance to valuation and as well as the management commentary, which we've mentioned now. So in order to do so, before beginning any calculations, I pulled 5 years of financial statements for UNH as well as the two competitors. And using those statements, I calculated the set of ratios. Everything flowed into one ratio model in Excel, and that is what I used in all the charts and graphs that you'll see moving forward in the presentation to compare the three companies across this time period of fiscal year 2020 to fiscal year 2025 and across the many categories. And then finally, I linked the results to valuation. If UNH is consistently producing higher returns with less leverage, the question definitely becomes, does the market reward that with a valuation premium or discount, which we'll also look at later. And the structure of the presentation moving forward will follow the order of liquidity, solvency, profitability, and finally valuation and risks. So diving into it, in terms of liquidity analysis on the surface, as you can see on the charts here, UNH appears to have weaker liquidity than its two competitors, with its ratio hovering around 0.7 and the quick ratio hovering around 0.45. While both competitors are higher in these metrics in most industries, you You wouldn't necessarily interpret this as a red flag, but for the companies in this insurance space, low liquidity doesn't necessarily equal weakness, especially for UNH. The reason of this is because of the cash cycle. A company like UNH is going to collect premiums continuously, most of the time on a monthly basis, and medical claims are also paid continuously. Unlike a company that you might see in manufacturing or retailing, insurers don't carry inventory. All the inventory values on UNH's balance sheet were zeroed out, and they also don't have lumpy cash outflows tied to seasonal production, as their business is notably not directly related to a singular product. Because of that, the constant inflow of cash that UNH is receiving, insurers like them deliberately operate with lower current assets relative to their liabilities, and the business model that UNH is running gives them an ability to generate liquidity as needed. They don't have to necessarily stockpile cash on their balance sheet. Cash flow stability is definitely more important than static liquidity. And this also sets up an important point that liquidity doesn't necessarily determine financial strength for insurers. It's more so looking at their solvency and coverage, which we will be transitioning to here. So in terms of solvency is where UNH really separates itself from the pack. Its total debt to capital sits around 0.4, and that's significantly lower than both CVS and Cigna. CVS has taken on more leverage due to recent acquisitions and its retail footprint, like we mentioned, in its brick and mortar stores, and Cigna also carries more debt relative to its capital. UNH's capital structure shows something more important, that they don't necessarily need to use debt to generate returns. They generate their returns organically through their operating performance. Debt to equity tells us about the same story. UNH is sitting around 0.68 compared to CVS, which is above the 1.0 mark. Less debt gives UNH more flexibility than a company like CVS, as they can invest any excesses that they have during certain uncertain periods. In times where we're seeing things like spikes in medical cost trends, where we saw in like 2023 and 2024, which you'll see on some upcoming graphs, without necessarily worrying about violating any of their leverage that they've tried to establish, or having to pull back on potentially paying out dividends or buying shares back. And when we talk about valuation later, these are of particular importance because companies with low leverage and more consistent returns almost always receive a valuation premium compared to heavily leveraged peers, which we see we have a nice distribution of in this competitor analysis here. Moving on to interest coverage analysis. Interest coverage analysis can tell us how comfortable UNH is with meeting its interest payments using its normal operating earnings from its core businesses. UNH consistently covers its interest expense 10 to 16 times over, and even in the most recent years, you can see on this line chart, when margins tightened, coverage was still close to 9.7 times. For context, CVS and Cigna, as you can see, generally fall within the 6 to 9x range. They remain relatively solvent, but they don't have the same protection buffer that UNH has. Starting in 2022 here, we see that the coverage ratio is gradually declining for UNH, but that change isn't driven necessarily by financial weakness or worsening investor sentiment in UNH. It's driven by three things that are happening simultaneously. First, EBITDA came down for UNH because of higher medical utilization. As our healthcare system normalized post-COVID, most large-scale healthcare companies had to resume elective procedures, surgeries, and outpatient care, which weren't occurring on the scale that they normally were during COVID, of course, with isolation. We saw this especially with Medicare Advantage. We saw a significant spike as you're seeing this drop in EBITDA to interest expense in higher claim volumes for Medicaid, which of course increased UNH's medical cost ratio, which management definitely addressed in their MD&A section of the 10Q filings as I was looking at them. Second, Optum, the second part of the business, which we addressed earlier, has been aggressively expanding over this most recent 2 years into its care delivery footprint by acquiring things like physician groups and clinics. And so when UNH acquires a provider, the expense hits immediately, while of course it takes time for them to realize that revenue over time. So EBITDA, of course, softens in those instances too. And then third, interest expense increased again during this 2023 to 2024 period due to higher Fed Reserve rates. Even though UNH uses much less leverage than the two competitors which we're looking at in CVS or Cigna, part of its existing borrowing is exposed to the market rates, and as rates were increasing during this period, interest costs, of course, increased. And the key takeaway from this decline that we saw from 2022 for UNH is that the declining ratio reflects strategic investment and temporary margin pressure and not necessarily financial stress for UNH. UNH still covers its interest even today, nearly 10 times over, even in this bit of a rough patch, which is still, as you can see, stronger than its competitors, even in their best years over this 5-year period. And this also reinforces the same theme from the solvency slide, which you just saw, that is that UNH has such significant earning power that it can support growth and absorb cost fluctuations, even in times of economic downturn, without relying too much on debt or sacrificing any shareholder returns. So moving on to profitability margins and the return on equity, we see that United Health consistently generates returns on its equity in the 20 to 23% range, while competitors we're seeing are falling significantly below, where CVS and Cigna are falling in the 10 to 13% range. Just looking at ROE alone, UNH is creating almost double the value per dollar of shareholder equity compared to its two peers in this experiment. And what makes this point even more compelling, in my opinion, is how UNH achieved that return. While some traditional companies may boost their ROE by increasing their leverage, CVS is a great example of this. Following its large acquisition activity, UNH takes a pretty opposite approach to that, in that their ROE is driven by profitability and asset efficiency, and not necessarily taking on debt or increasing their leverage. Optum, who we mentioned before, is a major contributor to that profitability. By producing service-based revenue through their care delivery, pharmacy services, and data analytics, which are only increasingly in demand through all these healthcare providers, these revenue streams carry higher margins than traditional insurance underwriting, which we'd see in something like Cigna or UNH's core business. Yet each year, Optum is representing a significant share of total revenue for UNH, which shifts the business mix more so towards higher margin activity and supports stronger returns. After 2023, you notice that ROE softened slightly, kind of following the trend that we saw on the interest coverage analysis on the past slide. The decline that we see here is, again, not a deterioration in UNH's performance necessarily. It's just a margin event that's caused by the significantly higher medical utilization that we saw right around the 2023 period, as the healthcare system balanced out and normalized a bit more following the post-pandemic. Members of UNH returned to outpatient procedures and surgeries at a much higher rate, of course, especially in Medicare Advantage plans. Medical cost trends increased much faster than premiums also, which compressed UNH's margins temporarily. And management directly highlights these utilization cost pressures in the MD&A section of the most recent and 10Qs that were released over this period also as well. What matters in this scenario, though, is how UNH responded. They, again, did not increase leverage to just artificially maintain their ROE. Even though it was dropping again, as we can see, it was still significantly above competitors. And they did allow ROE to normalize temporarily over this period, instead of taking on additional unnecessary debt just to try and boast these numbers to shareholders. The discipline and the dip here reflects a disciplined capital structure and operational reality, and I think some cohesive strategy planning in the management side of things also as well, and seeing eye to eye on what they wanted to do during this period of where they may have anticipated to see a significant spike in claims. So when investors are assigning UNH a valuation premium, it's not necessarily based on emotion or hype entirely. It's more so just confirming that UNH has consistent superior value creation, thanks to its margin strength and efficient asset usage, and not caving in when market trends occur in the healthcare space. So transitioning onto the MD&A and addressing the management, which we've mentioned a few times here. The MD&A tells us why the ratios look the way they do. So revenue for the first 9 months of 2025 reached $334 billion, which was up significantly from $299 billion in that same period the prior year. Management attributes this growth in these sections primarily to the membership increases, which would come, of course, sensibly post-COVID, and its continued Optum expansion, which we mentioned, that directly reinforces what I discussed earlier in that Optum isn't a small side division, it's a huge growth driver and factor in UNH's returns. Management in these notes also acknowledged higher medical costs and increased utilization. When more people are using healthcare services, especially in Medicare Advantage, UNH is paying out more claims, which temporarily pressures its margins. But management highlights that they maintain strong liquidity during these periods through constant premium inflows and disciplined capital allocation, which explains why liquidity ratios may appear low in certain points, but solvency ratios are still remaining strong. And the MD reading through the MD&A confirms that UNH's results aren't necessarily just lucky; they're the outcome of scaling, diversification in their businesses, and having strong operational control over their branches. So moving on to the valuation multiples, once you know the profitability and solvency story, valuation falls into place. As we can see, UNH trades at a higher PE and EV to EBITDA multiple than both its competitors in CVS and Cigna, meaning that investors are traditionally willing to pay more per dollar of UNH's earnings or seeing the earnings as more valuable. UNH delivers higher returns in ROE, lower leverage, more consistent earnings, diversified profit streams through Optum, which we've mentioned many times now, and how UNH doesn't necessarily need debt to generate value, and that alone reduces a bit of its volatility, which its competitors in this case can't necessarily boast as significantly. And investors we're seeing in terms of these metrics are preferring predictable earnings, especially in an environment like healthcare. So UNH is earning a premium multiple in this case. Transitioning onto its specific risks. The risks on this slide that you see here are specific to UNH, meaning that they stem from the structure of their business and not from just the general healthcare industry. These are risks that actually move their specific valuation. First, Medicare Advantage risk, first Medicare Advantage reimbursement and star rating dependency is a significant aspect of it, as UNH has more Medicare Advantage members than any other insurer in the U.S. The Centers for Medicare and Medicaid Services determines how much UNH is getting reimbursed per member each year, and those payments are tied directly to plan quality through their star ratings, as you can see in the graphic to the right on the screen. A one-star rating decrease doesn't just, for instance, a one-star rating in the star ratings wouldn't just affect future enrollment. It reduces reimbursement for every single existing member on that plan, which means a downgrade has a direct financial impact on UNH's revenue and margins. Because Medicare Advantage is a significant growth engine for UNH, it's more exposed to these star decisions and potential downgrades in ratings than competitors with less Medicare concentration, such as CVS. And then secondly, Optum's execution and integration risk is also a notable one that must be discussed. Optum's strategy is to acquire physician groups, clinics, and care delivery assets. But when UNH is acquiring a provider, the expenses hit immediately, as we mentioned earlier, and the revenue takes time to recognize. The financial risk here is that Optum won't grow, even though it has shown significant growth over recent years. The risk is that integrating thousands of physicians and aligning incentives across care delivery, of course, takes time, especially in the healthcare industry. And if integration slips or is delayed, margins are going to contract for UNH as a result. The success of Optum relies on UNH being able to not just buy providers, but actually improve the cost efficiency through their management experience and coordination. And then finally, regulatory and litigation exposure. UNH's size brings a spotlight. The risk isn't that UNH is necessarily doing anything wrong. It's just that regulatory pressure can limit profitability or require structural changes. And when a company is vertically integrated across insurance providers and pharmacy benefits like UNH's, any regulatory action, as we mentioned, has a wider impact. And none of these risks undermine the long-term value creation, fortunately, for UNH. What they do affect is valuation volatility. As we saw over 2023, in certain metrics, there was a decline due to factors. When reimbursement rates are revised, or when an Optum deal is being integrated, or when there are congressional hearings going on, UNH's stock may tend to react faster than peers because the market understands how those events flow through their financials and how it's directly tied. So putting everything together, UNH exhibits stronger returns, lower leverage, and more stable cash generation, all while operating in a more diversified business model than either of its competitors, which we looked at today in CBS or Cigna. The ratio analysis that we conducted shows real financial outperformance, and the MD&A and looking into the 10Ks and 10Qs confirms that management is intentionally investing in the areas that drive outperformance for UNH, and the valuation shows that investors are willing to acknowledge that strength with its strong performance over recent periods as well as its premium valuation. And with that, thank you so much. I appreciate you listening. Have a great rest of your day.